Welcome back to Rate Week. It is a huge week for interest rates this week, with the Bank of Canada expected to increase interest rates for the first time since 2018. Along with that, we've got everything that's happening in the Ukraine, absolutely freaking out markets. We have bond yields coming down, which means fixed rates are probably going to come down. And it's just been a wild week. I'm going to get into all the details in your March mortgage update coming up next. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. All right, so welcome back to the March mortgage rate update and rate week, as we're calling it this week. We have a whole bunch of things going on with videos pretty much every single day with respect to interest rates. We're going to talk about the Ukraine, we're going to talk about the Bank of Canada, and today we're going to talk about current mortgage rates in Canada. But before we get into it, do me a huge favor, hit the subscribe button and hit the notification bell, especially if you don't want to miss one of these videos. And by the way, everything is evolving this week with respect to interest rates, so you aren't going to want to miss one, because what we talk about today could be significantly different than what we talk about on Friday, given all the changes that are happening in the world. And by the way, if you're in the market for a mortgage right now, our Secrets to Getting the Lowest Interest Rate course is on sale until March 7th, just for this week, for $47. That is the lowest that we've ever priced it. It gives you all the information that you need to basically negotiate with a bank, a broker, get the lowest rate, and also understand what the landmines and surprises are that come along with the lowest rate, because a lot of people don't realize exactly what they're asking for when they ask a mortgage broker or a bank for their lowest rate. And I'm going to get into that. I'm going to talk a little bit later on here about what discounted mortgages are and how they could cost you money down the road. So let's start first and foremost by jumping into what's happening in the bond market, because the bond market is largely what affects fixed rate mortgages. The Bank of Canada has an impact on that, but fixed rates don't necessarily move in coordination with the Bank of Canada. And we're seeing that today, as basically fixed rates are now expected to come down after a 25 basis point drop in interest rates in 5-year bond rates over the course of the last 2 days, thanks to everything that's going on in the Ukraine and markets absolutely flipping out. So I'll show you what I mean by this. This is the Canada 5-year government bond yield, and it is currently at 1.48%. 2 days ago, it was at 1.74%. Pretty much the highest it's been in 2 years. And with everything that's happening in the world stage right now, we saw these rates come down quite substantially. We also saw the 2-year rate come down and the 10-year rate come down, which means that assuming that these rates stay at the level that they're at right now, which is about 1.5%, we should see that translate into lower fixed rate mortgages over the coming days and coming weeks. So the interest rates that you see today may not be what's actually available when you go to get your mortgage, if you're getting a mortgage this month. So you'll want to pay close attention to that. Now, why is this so important? Okay, so the Bank of Canada, they adjust their key lending rate, which ultimately affects prime rate. Prime rate is what affects variable rate mortgages, but bond yields are what adjusts the fixed rate mortgages, and the two don't necessarily move together, right? Because we're expecting a 25 to a 50 basis point increase in interest rates tomorrow from the Bank of Canada, yet we're seeing a 25% decline in bond market rates and subsequently a 25 basis point drop in fixed rates in the coming weeks here. So, really interesting things happening. That doesn't necessarily mean that fixed rates are going to come down, but there's less upward pressure as of today than there was 2 days ago on fixed rates. We've seen this reflected in the actions of a couple lenders who were increasing interest rates yesterday and then all of a sudden pulled those rate increases back today. So let's get into it and let's discuss the actual fixed and variable rates and what they are. We're going to start with full featured rates, then we're going to get into discounted rates. Remember, just like everything else in life, you get exactly what you pay for, and mortgages are no different. So the lower the rate, the less features, the higher penalties potentially, and the more restrictions that you're going to have, which could lead you to ultimately paying more for your mortgage if you don't understand what you're getting when you ask for a lower interest rate. So let's start with the 5-year fixed, full featured, insured, or greater than 35% down payment mortgages. These are the least risky to the banks and to lenders. Obviously, if they're insured, they're very low risk for the lenders. And if they are greater than 35% down, that's about where the bank looks at it and says, okay, we don't really have to worry about this client walking away from this property because they're starting day one with a ton of equity. So for 5-year full featured rate right now, you're looking at 2.99%. This is going to be an interesting contrast to the variable rates in a second when we get to them, because obviously you can get a variable rate for substantially cheaper right now. And depending on what happens with the Bank of Canada tomorrow, it still could be substantially cheaper after the interest rate increases. Now, moving into 5-year full featured fixed with 20 to 35% down. If you're putting close to that 35% down range, again, you're in that 2.99% range. And if you're putting around 20%, you have to pay a little bit of a premium because 20% down is where the mortgage doesn't have insurance. And that is a threshold where a bank will still provide you a mortgage without insurance. So therefore, it is the riskiest mortgage for that lender. So you have to pay a little bit of a premium, and interest rates on 20% down are about 3.19% or about 0.2% higher right now if you're in that 20% down range. Now, if you were to pay insurance and get a lower interest rate, it doesn't make sense. It would cost you more over the long run anyways. So it's still better to have no insurance and a slightly higher interest rate than it is to have a lower interest rate and an insurance premium in order to get that lower interest rate. So if you're at 19% down and you can get to 20% down, do everything you can to get to 20% down. Now, 5-year full featured variable rates, insured greater than 35% down payment, you're looking at about 1.35%. This could change as the Bank of Canada increases interest rates. If Bank of Canada goes up by 0.25% tomorrow, you'll see this rate effectively be 1.6%. If they go up by 0.5%, you'll see it be 1.85%, but still considerably lower than its fixed rate counterpart. Now, moving on to 20 to 35% down payment. Again, putting that 35% down, you're at 1.35% on the interest rate. And at 20% down, slightly smaller premium on the variable rate mortgages, you're looking to pay about 1.45% for a 5-year variable that has only that 20% down payment. Or in other words, is the riskiest for that lender from the perspective of not having insurance. Now, moving on to discounted mortgage rates, you're going to notice that these rates are lower. And there's a reason for that. It's because they either have restrictions or they've taken away features or they have higher penalties. Depending on the lender, depending on the company that you're getting this from and the product, it could be any of those things. It could be all of those things. It's really important to understand that when you are asking what the lowest interest rate is, that you also ask, what comes along with that, and also make sure that the person that you are asking understands the differences, because it's quite often you walk into a bank or you talk to a broker and they are selling you a product that they believe to be a full featured mortgage, and lo and behold, it is not, or it's a bank 5-year fix and it's got a massive penalty, and the lenders don't even realize that that actually exists. The person you're talking to doesn't realize that that actually exists because it is unknown to them. So you want to make sure that you're speaking with somebody who's experienced, somebody that you trust. The best thing you can do is find somebody who takes a fiduciary duty. So in other words, everything that they do has to be done in your best interest. Now, when we're looking at 5-year discounted rates, this, for example, would be the type of mortgage that has a bona fide sale clause, or in other words, a no refinance clause, or the inability to switch to a different lender, which potentially could be problematic if interest rates, like we're seeing on the 5-year fixed bond yields, begin to come down. If there's an opportunity to save money in the future and you have a mortgage like this, because it's got that restriction, you may not be able to switch to a different lender, which could end up costing you money over the long run. By the way, any broker, any banker can save you 0.1, 0.2%. We see brand new brokers come out of the course and they're doing that on their very first day. That is not the hard part, and that is not the valuable part of using a mortgage broker. The valuable part is using an experienced mortgage broker who's able to save you $10,000, $15,000, $20,000 somewhere down the road by going ahead and getting you a lower interest rate by virtue of taking your mortgage and switching it to another product or another lender when it's advantageous. We just recently did a mortgage for a client. He said, when Nolan talked to me 3 years ago, he said, we're going to look for these opportunities. And I thought he was just giving me lip service. And at the end of the day, we called him about a week ago. We said, hey, here's what we're going to do. We're going to adjust this mortgage. We're going to save you some money. And he said, you guys said you'd do this. I never thought the day would come. I thought it was just a sales pitch, but that's what we do because we're experienced. We make sure we get you in the right mortgage, not a discounted mortgage, and one that gives you the opportunity to save money somewhere down the road if somebody like me or somebody like my team is paying attention. So 5-year discounted fixed, insured or greater than 35% down, 2.74%. Again, that difference between 2.74 and 2.99 in most cases is a cup of coffee a week. If you're buying a really big house, maybe it's a couple cups of coffee a week. But if you're buying a really big house, you can also afford a couple more cups of coffee a week than somebody who's buying a smaller one. So the difference here from a savings perspective with respect to the interest rate is usually pretty insignificant. However, the lost opportunity down the road could be very significant to the tune of $10,000, $15,000, $20,000. So be very careful when you're selecting this type of mortgage, especially if you think that nothing's going to happen where you are going to want to get out of the mortgage, because lo and behold, it's the people who always believe that they aren't going to need that opportunity or that ability that somewhere down the road actually do end up needing it. Moving on to 20 to 35% down payment. Again, we're seeing that 2.74% rate to 2.99 depending on your down payment. And then getting into variable, this is a place where you can end up with a really, really, really great interest rate. 5-year discounted variable insured or greater than 35% down payment at 1.05%. The problem with this is if at some point you do need to lock in, this is the type of mortgage where you can't switch to a different lender, which means you have to pay whatever the lender you are at is telling you that you are going to pay when you go to lock in, which means they can charge you pretty much whatever they want. So the 20, 30 basis points difference here, you have to really weigh it and say, is it worth losing the opportunity somewhere down the road to lock into a better rate or switch to a better variable product? And am I willing to just put my trust in this lender and ride it out on variable and hope that if the day comes where I am going to lock in, that they're going to give me a really good deal? And by the way, the chances of them doing that are slim to none. Moving on to 20 to 35% down payment, looking at 1.05 to 1.15%. Again, weigh these versus the full featured variables. By the way, the one thing you really got to watch out for on discounted variable rate mortgages is the fact that they will use sometimes flat fee penalties, like a 3% penalty or something like that. And it can end up costing you a pretty significant amount of money to get out of the mortgage versus the 3-month interest penalty that it should have cost you. Now, the last thing I want to cover here is a very special rate that's available right now. It is available if at some point you had mortgage insurance or you're buying a property that has mortgage insurance. So in other words, at some point you put less than 20% down and you have an existing either Canada Guarantee, CMHC, Sagan, that's formerly Genworth, insurance policy on your mortgage. If you do have that, you have the opportunity right now to either switch, if you have an existing mortgage, to a very, very good 3-year variable rate, or if you're purchasing, you can purchase using this variable rate and get it at 0.99% for 3 years. This is a phenomenal deal. This is with a smaller lender that obviously is out there trying to get some really good business. We know the guys who run it. Very, very sophisticated president and CEO of this company. It's a smaller lender, like I said, but it is something that you should definitely look at, especially if you've got an existing variable. Let's say you're paying 1.45% right now, and you can get a 50 basis point discount off of that. There is some money to be saved here with these 3-year rates, especially if you're in that 3 to 4 year left on your variable rate mortgage term. So lots of really great things happening out there. Again, if you're in the market for a mortgage, I highly recommend that you take that Secrets to Getting the Lowest Interest Rate course, priced for just $47 until March the 7th. It is a phenomenal deal. If you don't get it by then, you'll never see it again at that price. I can promise you that. And we're looking forward to seeing what the Bank of Canada says tomorrow and what happens further with the bond market yields and interest rates, especially in the face of this Ukraine crisis. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Don't forget about our race to 25,000 subscribers, where we're going to give away $5,000 to one lucky winner. And we'll see you on the very next video. Cheers.